Now in this recording, we're going to be looking at the taxation of trusts. Now, trust can be something of a difficult area of law. It falls under the area known as equity, and particularly for non-law students, some of these things can be quite difficult to go through to understand the underlying fundamentals of trusts and how they work and how they operate. Here though, we're really trying to narrow the area we're looking at into the specific rules for the taxation of income in trusts. And despite the, I guess, the large number of rules and sometimes the complexity of the language used here, the important things to remember are when determining how income is to be taxed in trust, to remember these three aspects to each of the beneficiaries, and that is the present entitlement to income, the residency status of the particular beneficiary, and the legal disability or lack of legal disability for that particular beneficiary. We're going to look at these things in turn. Here, the problem scenario we have is a will, so in other words, a testamentary trust that's been created to vest, to be created, I should say, after a person is deceased. So here, the deed that creates the document, a will in this case, has stated that 50% of the income is to go to this person's widow, but 25% of the income of this trust to go towards their son who is mentally disabled, subject to an involuntary treatment order, and who is hospitalized, and 25% to be accumulated for the benefit of the 17-year-old daughter, but only to vest upon her age, reaching the age of 21. Also, in this instrument, the trustee has been given direction to apply income before she reaches the age of 21 for her betterment, for educational welfare. Now here, the trust has net income of $50,000 with $7,500 going towards or being applied towards the cost of the daughter's education. The widow receives his other income, net rents of $10,000. The son has $15,000 from a separate, different trust, another testamentary trust. And the daughter also receives some income while working part-time. So we're going to go through and calculate the taxable incomes for each of these three beneficiaries. And so the first category of beneficiary is one who is presently entitled to income and income distribution, who is Australian resident and is under no legal disability. These are the most simple and straightforward of all categories. And now, this definition of presently entitled comes from the common law, and it's when a particular person is absolutely entitled to this particular income in that particular year. In other words, there's nothing in the instrument, the document that creates this particular trust, that says that there is some form of contingency or other reason preventing this income from being given to the particular beneficiary. So here we have a straightforward situation. The widow is presently entitled. There's no mention of any contingencies, in other words, saying that she'll only get it under certain circumstances. Therefore, her share of the net trust income is $25,000. And that's added to her other assessable income in the same tax year. Now, here the $10,000 that the widow is receiving is not from another trust, it's from rental income. And so therefore, the widow has allocated to her $25,000 from the trust, and she, as the taxpayer, will be responsible for paying the tax on that. That's added to her $10,000 from rental income. And so she has a straightforward amount of $35,000 of income that she'll be paying using the normal marginal tax rates in the tax code. Useful to get an overview on, I guess, simple situations in taxing, particularly small and discretionary trusts. But I strongly suggest that you carefully go through each of these rules and areas just to revise and review this material, because it can be somewhat tricky. And the next situation is the son. This is a little bit more complex because the son, being in a secure mental facility, is under what's called a legal disability within the meaning of taxation of trusts. So here, he's also receiving income from multiple trusts. And so in each of these situations, the trustees are obliged to withhold tax. Now, here they use the term deduction. The trustee is obliged to deduct tax from the amount that would be distributed to the trustee. And that's included in this taxpayer, this beneficiary's tax return. Now, the important thing to note here, though, is that unlike tax credits from other sources, that these aren't refundable at the end after the particular taxpayer has done the return, and they can't be carried forward. And so here, the trustee pays tax using the individual's normal marginal tax rates. With the third beneficiary, the daughter, she is not what's called presently entitled. That is, she's prevented from making demands. She can't immediately demand a distribution of this income, and she's prevented through the actual instrument itself, the trust deed or the will. Now, notwithstanding the fact that she's not presently entitled to this, if, however, the trustee uses her or his discretion to actually put money towards this particular beneficiary, then they are deemed to be presently entitled to the amount that's paid or applied for her benefit. So here, if the particular beneficiary is under a legal disability, as with the son, the trustee is obliged to pay tax on behalf of the beneficiary, again, at that beneficiary's normal marginal tax rate. And income that is derived by minors, as we've seen earlier in the subject, is subject to penalty rates usually. Division 6, capital A of the 36 Tax Act actually makes the amount of tax payable for minors there's a punitive rates that apply. However, there's an exception to this, and the exception arises where there is a testamentary trust in this case. And so here also the daughter has $3,750 from her part-time job as well. That's also going to be accepted. That type of income is also accepted from the punitive rates in Division AA. And so here we would just add all of the income amounts for the daughter in here and just note that because she is under this legal disability, that the trustee is obliged to withhold this, to make this deduction. But that amount, that credit, can be used to offset other tax that may become payable for that particular taxpayer in that particular tax year. Now, the next thing to note is that trusts, unlike partnerships, aren't actually obliged to distribute all of the income in a particular tax year. However, if the trustees, for whatever reason, usually when there's no presently entitled beneficiary, when they don't distribute income in a particular tax year, it's going to be taxed at the top marginal rate. There's really a punitive rate that applies here. Now, there are some exceptions to that, and basically the particular trust has to fall into a particular type of exceptions, and the commissioner must be of the opinion that it's unreasonable for the 45 or 40 cents to the dollar rate to actually apply. Both those things have to be true, and the commissioner has things to take into account. And one of those things is the fact that something is a Australian resident estate, trust estate, that's created usually through will or testamentary trust. And so thus, while the commissioner has discretion there, it's pretty likely that the commissioner will find that it's unreasonable for the top rate to apply in this particular situation. And it's likely that the trustee, while it still will be liable to pay tax, it'll be at normal taxpayers' marginal rates. The next question is looking at revocable trusts. Now, these are the situation, and look, it's something of a tried example. It's a situation where a person who has or holds property creates a trust for the benefit of immediate familial relations. And the reason why it's a slightly tried example is that the punitive sort of anti-avoidance measure in section 102 is actually really easy to sidestep. Because basically there's two ways to go about doing it, and they come from the cases of Truesdale and from Hobbs. Now, in Truesdale, the court said there that, look, this, and they took a very, very narrow view of this particular section, unlike in other jurisdictions, it really says where a person creates a trust. So in other words, where an individual who holds the property creates the trusts themselves. And the very simple and kind of silly way to bypass that is to get a third party to create the trust, even for a tiny amount. Historically, it's been $10. So a friend of the family or the family accountant or solicitor will put $10 into a trust, and then the taxpayer would simply move the remainder of the property, be it real property or a large sum of cash, into the trust. And thanks to the way that the court held this in back in 1970 in Truesdale, they said, well, yeah, that's fine. That's a legitimate means of bypassing this particular anti-avoidance mechanism. Also, the case of Hobbs actually said that Section 102 can also be avoided by carefully creating in the document that creates the trust, be it a testamentary or inter vivos document, stating that there are certain contingencies that must apply, but the trustee can state that while the corpus and income won't vest in absolutely to the children until they reach a certain age, for example, perhaps the age of 21 or 30, the trustees can have discretion to apply income towards them for their maintenance, support, education, or other beneficial purposes. And again, the courts in Hobbs said, look, that is a legitimate mechanism and structure in order to defeat Section 102. And so really, as an anti-avoidance mechanism for really trying to trap people from creating trusts and doing things with their family, Section 102 is quite ineffective. And really, that's what this question's designed for you to discuss. In this part of the recording, we're going to look at a more complex situation. And so here we've got people that are, or beneficiaries, I should say, that are, some of whom are presently entitled, some of whom may not be, some of whom may be under a legal disability, and some who might not be, and some whom may not be resident in Australia for some or all of the particular tax year. And there's a little bit of complexity in terms of the appropriate rules to actually go about taxing these in trust and the taxation of trusts. So we're going to go through these in a bit of detail. And so here we have a family trust, which half of which is income is actually Australian, and the other half is sourced from overseas. So that's $80,000 each way. And the instrument, so the document that creates this particular trust, says that 25% of the income is going to be going to Harry, who is an accountant practice in Townsville, so a person who's essentially resident at common law for the entire tax year period. We've got 25%, so a quarter is towards Ian, who is 17 years old, so he's a minor, and he lives in New Zealand with his mother throughout the entire 100% of the tax year. And the balance of the income is to be paid at the trustee's discretion to Jim, who is a cousin who has moved to Australia and became resident ordinarily on the 31st of December last year. So they're essentially in Australia for only a fraction of the tax year. Now, with this, I guess, more complex trust taxation example, we still need to look for each beneficiary at these three things: present entitlement, the legal disability, and the residency status for each of the beneficiaries of this trust. And when stating these and answering the style of question, it's a really good idea to actually explain what each of those things mean. So from Taylor, you can take the definition of presently entitled, which is to have an absolute and indefeasible vested interest in possession of this particular income. Now, in situations where there is discretion. In other words, the trustee chooses whether a person is going to receive income or is not going to receive income in a particular tax year. A person is not deemed to be presently entitled by default unless the trustee actually exercises that, unless they actually apply income to that particular taxpayer or towards benefits for that particular taxpayer in that tax year. Now, legal disability is to be prevented from being able to actually take and use and apply that income. And so there is a list or class of persons, and this includes minors, includes bankrupts, and it also includes those that are in secure mental facilities. Finally, residency has a definition in Section 6 of the 1936 Act. And there's a four-limb test. The person's Australian resident, either if they're deemed to be resident of the common law, in other words, they ordinarily reside in Australia, or they are domiciled in Australia, unless that particular taxpayer has a permanent place of abode outside Australia. Thirdly, if they are physically inside Australia for 183 days, or if they're part of a certain class of government superannuation schemes. If any of those four things are true, then a person is deemed to be resident for that particular period. And so here, the first of these beneficiaries, he really appears to be just entitled to this 25% share of the income because he has this right to demand immediate payment. And he also does not appear to have any form of legal disability. Nothing in the problem scenario suggests this. And his accounting practice is in Townsville. And so there's no evidence that he's non-resident in this particular tax year. And so really this is the simplest of the three sort of statuses in terms of this particular type of tax question. The second beneficiary, Ian, is also apparently presently entitled to this particular income, the same amount of $40,000, but he's a minor, so therefore he's under a legal disability. And his residence, his place of residence ordinarily is in New Zealand. And there's no evidence of the other limbs applying, that he's domiciled or he's been here for 183 days or is part of a circuit scheme. So therefore, he is deemed to be a non-resident for the purposes of this trust distribution taxation. And finally, the third beneficiary, Jim, his entitlement depends solely on the discretion of the trustee. So it's only the amount that he's actually they've actually applied to him in this particular tax year. Now here the problem scenario actually says, look, hey, look, we're actually going to exercise this discretion and give the guy the same as the other. So he's actually going to be given $40,000, and as such, he's not going to be considered to not be presently entitled. So he is presently entitled to that amount. But also note that he has been in Australia for 6 months. He's been ordinarily residing in Australia for only half of this particular tax year. And also, the last thing you need to note for this style of problem is the remainder. So that a quarter of this income, $40,000, no one is presently entitled there. And it's really important when answering questions on trusts and the taxation of trust to account for that. It's very important because the trustee, as you'll see later on, is going to take responsibility for paying those amounts. Now again, after we've calculated the status for all three of these things, present entitlement, the legal disability, and the residency, we then have to go and find the appropriate legal rules in the 36 Tax Act to determine how and where the particular income streams are going to be taxed. And so here, starting with the simplest case, Harry is presently entitled, no legal disability, and Australian resident. He pays his own tax. So in other words, the $40,000 is distributed to him, and he just includes that in his assessable income. And so he's really responsible in that situation for just paying his own tax to the commissioner and using his own ordinary marginal rates at the end of the year. Now with the second beneficiary, Ian, he is presently entitled, and he's also, though, under a legal disability, and he's non-resident. Now, in situations like this, the trustee has to take some responsibility here. Now, the difficulty is, though, is that the amount that the trustee has to pay tax for is only going to be the percentage of income that's actually attributable to this particular beneficiary from Australian sources. As we're aware, Australian residents pay tax on worldwide income, whereas non-residents only for Australian sourced income. Now, interestingly, the trust deed, or the document, the instrument that creates the trust in these sort of scenarios, can actually state how Australian sourced and non-Australian sourced income is to be applied. If, however, it is silent in terms of how it's applied, it's just going to be a proportion. So here, for example, half of the income was derived from Australian sources and half from non-Australian resident sources. And so that's simply the fraction, 50-50, that is going to be applied in this particular situation. So here, half of the income that's applied towards Ian is going to be taxed in the hand of the trustee. Now, the other situation here is that the non-resident, so the trustee is going to be liable to pay tax on this $20,000 using the rules for non-residents, their individual marginal tax rates, only if it's a testamentary trust. And the reason for that is that if this is not a testamentary trust, then the penalty rates are still going to apply. So this $20,000, you're going to have to use the punitive rates in Division 6, capital A, capital A, if it's not a testamentary trust, because it's income that's being applied to a minor. Now, with our final beneficiary, Jim, he's been in Australia, he's been resident for half the tax year, and he is deemed to be presently entitled because the trustees exercise this discretion. And so under Section 101, he's deemed to be presently entitled to that particular income in terms of taxation. Now, there's a bit of a double whammy here. He's going to be liable to pay tax only for the fraction that he's resident and for the fraction that he's non-resident. He's going to be deemed to be paying tax for the amount that's Australian sourced. And again, the trust instrument is silent in terms of how and where these amounts are applied. So for this particular taxpayer, he's received $40,000, or that's the income that's going to be allocated to him. But 20,000 of that is the fraction that he's going to receive because he's resident. And also, of the other 20,000, half of that is going to be from an Australian source. And so he's going to be taxed on that as well. So therefore, his tax liability, the amount he's going to be paid, is going to be $30,000. And because he's a tax resident at the end of the income year, the trustee isn't responsible to do anything here. So the trustee isn't obliged to deduct any tax. They're just going to hand him this amount, and he's going to have to pay tax at his normal marginal rates on this $30,000. Now, finally, the balance of income. Now, by default, income that's not applied to beneficiaries, either because the trustee chooses not to use their discretion or because there aren't any beneficiaries that are entitled to that particular income, that's going to be taxed punitively. It's actually taxed at the top marginal rate. Now, there's some exceptions to this. And basically, those exceptions say that, look, first of all, you have to fall within a list of one of the exceptions that is listed in the legislation, one of which, by the way, is that there is a testamentary trust. And the commissioner has to deem it unreasonable for this particular taxpayer to be paying this top tax rate. Now, one of the things that the commissioner does take into account is whether or not something is a testamentary as opposed to inter vivos trust. And if the commissioner does consider it unreasonable, then the trustee is still going to be liable to pay tax, but it's going to be at a normal resident marginal tax rate, as if it was a natural person. And so here, this particular situation, the balance is $40,000, to which there's no presently entitled beneficiary. And by default, it would be taxed at the hands of the trustee at the top marginal rate. And it's unclear in this particular problem scenario whether or not it is actually going to fall within one of these exceptions. It's not clear, for example, in the problem whether this actually is a testamentary trust. And because of that, if it doesn't fall within this list of exceptions, it doesn't really matter whether the commissioner considers it to be reasonable or unreasonable. The trustee is just going to be liable for the top tax rate. And so while this $40,000 of unallocated income is going to be taxed at the top margin rate, we also need to note here that for one of the taxpayers, the trustee is responsible for withholding their tax, for passing that on to the commissioner, and that's Ian, the non-resident minor. In that situation, it's either going to be at his particular marginal tax rates or under the penalty rates in that particular case. I hope this has been